Okay, good afternoon. Can you hear me? Hello. Yep. Okay, see some response here in the chat. Yeah, thanks for your response. Good afternoon. I'm Rafty here. I'm gonna be your tutor for the rest of the semester. So this is the class for corporate finance. I hope that you did not go to the wrong class. This is corporate finance. Section. I'm not sure which section is it. It should be section 2. Okay. So I'm a part-time sessioner here, part-time lecturer in Taylor's. Monday and Tuesday I will be in Taylor's, and the rest of the day I won't be in Taylor's. So if you have any issues that you need to address it to me, please send it to me via email. Okay, if you need to make a consultation session with me, please make an appointment with me via email too. All right. So the today's discussion will be on chapter 1 and chapter 4. Uh, Introduction to corporate finance, and also valuations, discounted valuations. Okay, so I'll begin our class soon. There are 22 of you already. Okay, and if you need to watch back the video, you can always go to the YouTube, my YouTube channel, which is already being live now. You can have the link, I guess. I don't know how it is work, but it will be on YouTube. Uh, yeah, I think this is the link. So if you need to rewatch the video after this, you can always go back to the link to watch it. All right. The solution will be uploaded. The textbook solution will be uploaded by your CE, your module leader. Okay. So if you are hoping to listen back to my recording, please go to the link, the YouTube link that I just shared with you, because today's tutorial will be live on there, and you're going to be recorded automatically, and you can play that. Okay, so let's start with today's tutorial. I hope that you have the question with you. Okay, if I speak too fast or you can't follow me, or there's anywhere that you need me to further explain, please stop me via the chat in Zoom. Okay, and I will repeat it for you, or I will try to make it clearer for you. Okay, so we shall start now. So let's start with chapter 1, Introduction to Corporate Finance. So the questions here is like this. List and briefly explain the 3 basic questions addressed by a financial manager. All right, so what are the 3 basic questions addressed by a financial manager? So number 1, their favorite questions is, what long-term investment should the firm choose? Okay, what long-term investment should the firm choose? These are the one of the most common basic questions addressed by a financial manager. Okay, so when they ask you what long-term investment should the firm choose, this is basically asking about capital budgeting. Okay, or also known as investment decision. So what is capital budgeting and what is investment decision? Basically here is deciding on how are you gonna invest into your business. Okay, so if you are a financial manager of a business, under this section on capital budgeting and investment decision, you are considering how are you gonna reinvest into the company. Are you gonna expand the company? Are you gonna buy a new assets? Are you gonna invest more into the research and development? Are you coming up with a new product, and so on and so forth? This is basically long-term investment should the firm choose. Okay, so capital budgeting, or it's called investment decision. You're considering how are you going to expand the business, or what are the things that you might want to buy to enhance your business or make it more profitable. That is investment decision. Okay, the second question that they like to ask to financial manager is, how should you fund the selected investment? Okay, how should firms raise fund for the selected investment. So after question number 1, you already decided maybe you want to buy a new building. Okay, so you decided to buy a new building, but the problem here, how should you get the money for this new building? So this we'll call as capital structure. Okay, capital structure, or also known as financing decision. How are you going to get the money? Are you going to get it via debt? So capital structure, it could be separated into two. It's either via debt or via equity. Okay, so debt means what? Equity means what? That means, for example, you issue bonds, you take loans, you borrow from people. That is capital structure by debts. Equity means you're giving out shares, not give lah. So you sell shares, okay? Or you give out a portion of the company to people. Merger and acquisition, and etc. Okay, so equity means people injecting capital into you. That means you're you're borrowing money from other people. So you could borrow from banks. You can borrow from if you borrow from banks, it's called loans. You can borrow from friends and families. Okay, you can borrow from the public. That one is called bonds. All right. So capital structure means a financing decision. It could be via debt or via equity. Okay. So lastly, the last common questions that being asked is, how should short-term assets be managed? Oops. Assets be managed and financed. This one is the last one, which is called the working capital management. So for those of you who are from accounting finance or banking finance background, these three things that you see here is something not new to you. Capital budgeting, capital structure, and working capital management. Okay, so what is a working capital management? Basically, is the control of your day-to-day finances. All right, your cash, your inventory, your credit sales, your short-term financing, and etc. So this is working capital management. This is to sustain your daily operation of a company. Okay, yep. So these three things are the most important things that a financial manager will always want to have something in mind regarding an organization. Number one, the capital budgeting or investment decision of the firm. Number two, how are they going to get the financials? Okay, that's financing decision. So whether you're going to be debt or equity. And lastly, how are they going to control their day-to-day expenses or expenditures with working capital management? Okay, so I hope that all of you are clear. All right, so usually I will go on with the questions unless any students stop me via the chat. So if you have any issues, maybe regarding the speech that I'm delivering, or you don't understand some of the terms I'm using, most of the time I don't use any very technical financial terms. I'll try to make it as easy as possible for you to understand. So if you need the textbook definition or textbook answer for certain explanation, you might want to refer back to your textbook. Okay, the purpose of the tutorial is to assist you on understanding a certain questions and problems, and you know how to tackle it with your own way. Okay, hopefully that give you a different approach. Let's go to question number 2. What advantages does the corporate form of organization have over sole proprietorships or partnerships? Okay, so corporate, in short, corporate versus sole proprietorship or partnership. Okay, sole proprietorship means you own it yourself, only you one person. Partnership means you are partnering with somebody lah. Okay, so in other words to define this, in Malaysia this corporate will be more towards sembilan berhad. In overseas you call it private limited. Okay, as for this it's more as enterprises, so they are not being monitored by any auditor or any company secretary. Okay, so what are the advantages of being a corporate form of organization versus proprietorships or partnerships? Okay, so number one, easy transfer of ownership. Okay, easy transfer of ownership. Why is a corporate company is easy to transfer? Because everything is being audited nicely. Whereas a sole proprietor and partnership, everything is you manage it yourself. Okay, this corporate could be any other company like existing in the out there now. It could be Sunway Group. It could be what do you call that? Taylor's. Taylor's is a corporate. Okay, so proprietorship or partnership, it most probably be the burger seller, the hawker person. Okay, the newspaper vendor in the roadside. Those are also proprietorship and partnership. So it's easier to transfer of ownership for corporate. Number two, the owners, okay, owners have limited liability. Okay, that's why it's called private limited. It's only limited to how much the company to sustain. If the company go bankrupt, the company bankrupt, not the owner. The owner might still be rich. Okay, so the owner are not responsible for the business's debts unless they individually take out as a guarantor to those debts. Other than that, if the company die, the company close shop, never mind. Owners still might have money with them. Okay. Number three, easier, oops, easier to raise fund. Okay, or easier to raise capital. So as a corporate, okay, you want to raise funds, you can issue bond. Okay, you can release shares. But enterprises, so proprietorship, partnership, you can't do that because there's no valuation. You're not properly audited. How are you going to issue bonds? How are you going to assure people that you're gonna make money? And how are you going to release your share? Your shares don't even have a value on it. Okay, and lastly, unlimited life of the business. Means when you register under a corporate, under Sembilan Berhad, as long as you did not close it, your business will still be there forever. As for this, it's basically based on renewal basis. Once you did not renew, gone. There's no more there. Okay, so these are the 4 points here. Very simple. All right. Okay. So anyone having any issue so far? Any difficulty understanding? Anybody? Yes, no? No. Very good. Thank you, Soldier, for responding. Okay, so let's look at question number 3 now. What should be the goal of the financial manager of a corporation? Thank you, Manda. All right, of a corporation, and why? What is the goal of a financial manager and why? Okay, so remember this. What does a goal of financial manager for corporation? It's very simple. They got only one goal. Most of the time, this is a very common goal shares amongst financial manager, regardless wherever you are. Okay, so which is maximizing shareholders or the shareholders. Well, okay, this is their main goal. Okay, maximizing shareholders' wealth. How? Maximizing the maximizing their stock value. Why is that? Whenever I use the tutorial word file, my Microsoft Word crashes. Or I'm not sure what is the problem with the word file. Okay. Yeah, I can't answer you on that. It is some technical issue there. Yes. Maybe you want to use another file. Don't just use the tutorial word file. Okay. So back to the question here. What should be the goal of the financial manager of a corporation and why? So their main goal is to maximize shareholder wealth. How are they going to do that? By maximizing their stock value. Okay, so simple as that. All right. So basically answer both sides. The why is basically to maximize the shareholder wealth. Their goal is to maximize the stock value of the firm. Okay, so moving on to question 4 now. Do you think agency problem arise in sole proprietorship and or partnerships? Okay, so what is agency problem? What is agency problem? Okay, to define agency problem is basically conflict of interest between the management team or between staff and the owner. Okay, and the owner. So, do you think agency problem arise in sole proprietorship and partnership? So in this case, no, it won't happen. Why? Because sole proprietorship and partnership are usually owned by or runs by the owner themselves. So when the owner is running the own businesses, their goals is the company goal. Yes, owner doesn't mean owner doesn't guarantee you as shareholder, but shareholders are owners. Okay, shareholders are part of the owners. Okay, does agency problem means conflict between internal and external people? No. Okay, agency problem is basically a conflict between internal people only. Internal as in the staff and the owner. Okay, so in this case, in proprietorship and partnership, they are run by the owners itself. So you see the hawker fella, the fella who sell the chicken rice in the hawker center. So the boss is the one that's slaughtering the chicken, the one that cooking the chicken and chopping up the chicken and serve you, right? So his goal is to sell all the chicken there. Okay, or to sell as much as he can. Already, if if that's a corporation, if that is a corporation, that means the boss outsource the shop, okay, the chicken rice shop to another person. So maybe they hire a person to handle it. Okay, this person who work for the boss will be chopping chicken and selling chicken rice as though as he's the boss. But what is his goal there? His goal as a staff is to finish work at the allocated time. Correct, no? Makes sense, huh? You take this example. So, for example, if you are the one running the chicken rice shop, you're the one chopping the chicken. Okay, although you say your closing time is 5 p.m., but you still have chicken to be sold. Okay, and there's still customer coming in. You won't close. You continue selling until there's no more customers. That's the owner perspective. That's the owner's goal. But if you hire somebody to do that for you, his working hour is 10 to 5 p.m. So do you think that when 5 p.m. customers coming in, he or she are still committed to continue or not? There's a high chance of that person say that we are closed, come back tomorrow, regardless whether there's still chicken or not. Makes sense or not? Makes sense, right? Guys, are you over there? Yep, makes sense. So if it makes sense, means there's already conflict of interest. If you are the owner, you want to maximize your sales. You want to sell, okay, even though it passed your closing hour. But if you hire someone to do so, their goal is they work until 5. That's all, full stop. They want to stop work. So this already shows a conflict of interest. And this is what we call agency problem. Okay, in the easiest way to say it. But of course, it's much more complicated from there when you talk about big organization and agency problem here, about own benefit, own commissions, self-benefit, about giving a tender to your closest people and so on and so forth. So all these things could be caused by, it could be due to agency problem. Okay. So there are several true and false questions here. We'll discuss this very quickly. Okay. So let's look at the question together. I hope you guys have the question with you. I will read it out to you. The board of directors is ultimately responsible for all large investment decisions. True or false? So the answer here is true. Okay, true. All large investment decisions must go through directors. Okay. Number 2, a corporation has a legal existence of its own and is based on articles of incorporation. Yes, definitely this is true. Okay, they already have their set of do and don'ts and requirements before they can consider as a corporation. Number 3, real assets of a corporation are claims on their financial assets. This is false. Okay, false. Real assets of a corporation are claims on their financial assets. False. All right. Number 4, the treasurer responsibilities include preparation of financial statement. False. Okay, that's not the treasurer responsibility. All right, that's the accountant's responsibility. In large firm, number 5, there is usually a CFO or chief financial officer who oversees both the treasurer and the controller's work. True. Okay, true. This chief financial officer will be the head of all these treasurers and all these budgeting and so on and so forth. So they control. All right. And number 6, the controller responsibilities typically include banking relation and cash management. This is false. False. Okay, false. The controller basically just they don't need to do banking relations and they don't need to care about cash management. They are only the what do we call that? The compliances. And number 7, manager, shareholders, and the firm's debt holders have identical information about the value of the firm. False. Okay, false. All right. Not everyone can know about the information about the firm. Okay. Normally, the one that know is only the controller, the CFO, and sometimes the shareholder. Okay. So managers, sometimes they don't even know anything about the company valuation. They only manage their own department. That's all. All right. So these are some of the factual statements here, so that you can identify what is true, what is false, to give you a better idea. Okay. So this is for chapter 1, Introduction to Corporate Finance. So do you have any questions so far? All right. So now, before I go on to the second section on chapter 4, okay, I'll give you a short 5 minutes break. Now it's 12:30. So come at 12:35, you'll continue with chapter 4. Okay? It's just for you to do some stretching and to prepare, to reset, to save your file, whatsoever. And then you start at 12:35 with chapter 4 on discounted cash flow valuation, the second part of today's tutorial. Okay? So see you guys in 5 minutes time, 12:35. So you can go to the toilet, have your toilet break. The answer for number 3. Again, number 3 is real estates of the corporations are claims on the financial assets. So the answer here is false. Okay, real assets are not the claim on financial assets. And Kiwi, false, huh? Okay. So go and have your short break and whatsoever. Come at 12:35. We'll continue with our tutorial at 12:35. See you. Okay, welcome back. Are you all back here? Are you ready to continue? All right. So, some calculation will be going on in this section on chapter 4. So let's look at the question together. I hope that you guys already have the question with you. First, Citibank, question number 1. First, Citibank pays 8% simple interest on saving account balances. So they are First Citibank, 8% simple interest. Whereas second Citibank pay 8% interest compounded annually. So this is the difference. One is paying you simple interest, another one is paying you compounded. Okay, if you made a 5,000 deposit in each bank, how much more money would you earn from your second Citibank account at the end of 10 years? So they're telling you, if you deposit 5,000 to each bank, how much are you going to get in the second Citibank account? So if you want to put in a timeline, it's very simple. It's basically like this. Now it's time 0. Okay, 10 years down the road, you have $5,000 now. How much is your future value when your interest rate is at 8%? Okay. So for First Citibank, very easy because it's simple interest per year. Okay, it's simple interest, 8% simple interest per year. So First Citibank, you will look at this. First Citibank, simple interest. You deposit $5,000. Okay, and then each year you're going to gain interest of 8%, 0.08. So in other words, you're gaining $400 per year. All right. So for 10 years, your interest will be 400 multiplied by 10. So that's going to be $4,000. Okay. So in the end, because the question asks you, they did not really ask you to count this, but then in the end, you know your total balance for First Citibank, including your initial investment, 5,000 untouched, the extra $4,000 interest, you get $9,000 in total. Okay, so the question tells you how much more money would you earn from your second Citibank account at the end of 10 years. This is for First Citibank. All right, the second Citibank investment, how much you get? Second Citibank, they tell you is compounded annually. So if it's compounded annually, you use this formula. FV equals to PV times 1 plus R power of T. Okay. The present value is given. You say that you invested $5,000. Interest rate is 8%, so 1 plus 0.08, and compounded by 10 years yearly. So your future value, okay, the 10 years after getting the compounded interest, the total lump sum that you get, if you use a calculator or if you use your financial calculator, yes, you get 10794.63. Okay, so this is the final amount you get with second Citibank. So the question asks you how much more money you earn. So take 10,794.63 minus your $9,000. So you're earning an extra of 1794.63. Okay. To answer this question, if you use the scientific calculator, this is what you key in. If you're using the financial calculator, just click plus minus 5,000 equals to PV. Okay. 8% equals to your interest, 10 for your N, and compute FV. So I don't know what kind of calculator you're using, but this is the easiest way to key in. Key in your N is 10, your interest rate, consider as R. Some calculator will be written as I/Y, interest per year. Again, your PV, some calculator require you to put the plus minus. I think if you're using the BA2 plus, you must put the plus minus here. If not, you get a negative future value. So when you compute, you get 10794.62 something something or 63. Can, huh? So calculator shouldn't be an issue. I think you guys are familiar with calculators. Okay? All can get this or not? Can all of you get this? So who cannot get, let me know. Very good, Risha. Thank you. Okay? Very good. All right. So this is the first question. Very simple. Okay? Simple interest versus compounded interest. All right. Can I use the Google? No. No. In the exam, you can't open any external file by right. Okay? So you need to use your calculator. Your own calculator. Okay? Yeah. All right. Moving on, question 2. This is a practice now for you. Okay? There's a practice here on question 2. Let's see. Let's practice together then. Try to use calculator, scientific calculator, and so on and so forth. So compute the future value of 1,000 compounded annually for A, 10 years at 5%. So $1,000 also start with $1,000 compounded annually. A, 10 years at 5%. So start counting this first. So if you put your timeline, time 0, 10 years, interest is 5%. Okay, initial value is $1,000, your PV. You need to compute your future value. Okay, so those who use calculator, very easy. Put in your PV, put in your N is equals to 10, your IY equals to 5, compute FV. Those who not using calculator, use the same formula I showed you just now. FV equals to PV 1 plus R power of T. So this will be 1,000, 1 plus 0.05 power of 10. Okay. B, 10 years at 10%. 10 years at 10%. So use back the same formula again. FV equals to 1,000, 1 plus 0.1 power of 10. What do you get? Count, you need to count yourself. C, 20 years at 5%. FV 1,000, 1 plus 0.05 power of 20. Okay, so count, find out the answer. A, B, and C. Use scientific or use your financial calculator, both also shouldn't be an issue. This is very simple. So what do you get for A? Come on. 1628.85. Okay. 1628.89. Okay. So I think 1628.89 is much more accurate. All right. 1628.89. 2593.74. Yep. 2593.74. And last one, C. Anyone got 2653.3? Very good. 2653.3. Okay, so everyone should get all these three. 259, 265. Yep. Okay, very good. All right. So now, after having all these answers, question B, what do they ask you? Why the interest earned in part C? Why part C? Okay, not double the amount of part A. Why part C is this? Part A is this. Why it's not double? Because it's still at 5%, right? So one is 10 years at 5%, one is 20 years at 5%. Why is it not double? Okay, very easy to answer this. Okay, they are talking about the interest. All right. So if you talk about interest, A is 628.89 because minus 1000. This one is 1653.3. So is 1653.3 double of this or not? Hmm? Okay. 628.89 versus 1653.3. Is 1653 double than this at least or not? More than double, right? More than double, right? Okay. So yeah, you see by right, you see 10 years, they give you interest 628.89. 20 years, they give you 1653.3. So if you double, it's only 12 something, 125 something, 1256 or 1257 something. So you're getting extra 400 over dollar. Why? Yes, 1257.78. So why are you getting so much extra? Because it's being compounded, interest being compounded on interest some more. So you're getting more than double. Okay, but of course, when you look at this is not double. Why? Because this is including the initial $1,000. So you deduct the $1,000, then you can see the interest is actually more than double because it's being compounded for another 10 more years. Can, huh? So to answer this question, very simple only. Okay, the total volume here is already included the initial capital. Okay, but if you count on the interest, 20 years is actually having more than double of what you have in A. Again, you have more than double when you have it on 10 years because it's interest being compounded for extra 10 years. All right, can, huh? Okay, so I hope that you guys could do this at your own, practice it yourself, whether you're going to use a scientific calculator or you're going to use the financial calculator. Make sure that you master both of it. Okay, all right, so we're done with that. We move to 3 now. Number 3, again some practice question here. All right, to help you a bit to understand further. Question number 3 here. For each of the following, compute the present value. Okay, compute the present value. So first, they give you 6 years. All right. Let's say A lah, huh? A, they give you 6 years. I draw in timeline straight away. 6 years. Year 0, year 6. Okay, they want you to count the present value, unknown. Future value here is 13827. Interest rate given to you is 7. So now this one, they want you to count the PV. So PV is equals to, just reverse the formula just now, FV divided by 1 plus R power of T. Okay, so replace your FV 13827 divided by 1 plus 0.07 power of 6. What do you get? Okay, this is A. V, again, put on a timeline if you want to have an easy understanding, okay, or to let you remember. Future value 43852. PV you need to find 9 years. Interest rate is 15%. So replace into the formula again. PV equals to FV, 43852 divided by 1 plus interest, 0.15 power of 9. Find out the answer. C, no need to draw timeline lah. You know lah. PV is equals to your FV, 725380. Don't be worried about the big number. Not scary enough. 1 plus 0.11 power of 18. And lastly, PV equals to 590,710. 1 plus 0.18, 18%, power of 23. So you can use financial calculator or scientific calculator. If you use financial calculator, key in 13827 equals to FV, 7 equals to IY, 6 equals to N, compute your PV. You will get a negative answer. So don't care, put it as positive. Okay, put it as positive. So what do you get for A? Anyone already completed? Anybody? 9213.51. Okay, 9213.51. Yep. Next one. 12465.5. 12465.48. Yes. 12465.48 is the accurate one. Yep. 12465.48 accurate. Correct. C. 110854.15. Yes. 110854.15. And last one. Yep, 13124.66. Okay. I hope that you all don't just go and take from the solution there and give it to me. Go and count, try calculating it with your calculator. Okay, that's more important. I know answer is given to you guys, but if students don't practice in the exam, you will suffer. You'll face very, very problematic issues. Okay. If it's a price, you will round it to 2 decimal point. Okay. If it's a pricing, you round it up to 2 decimal point. Yep. All right. Question number 4. Question number 4. This will be a challenge to those who use scientific calculator. Okay. Because question number 4, they give you the present value, the years, and the future value, but not the interest rate. So look at the first one, A. Okay, A. If you put into the timeline, all right, for 4 years, 0 to 4 years, given to you present value is 242, future value is 307. Interest rate is unknown. All right. So you use the FV formula, of course. FV equals to PV 1 plus R power of T. Okay. So FV is given to you 307. PV is 242. 1 plus R unknown, power of T is 4 years. So if you want to calculate this, how do you going to do it? You need to shift it. Okay? You need to shift it. All right. So the formula for this is R equals FV divided by PV power of 1 over t minus 1. It should shift 1 by 1. So in this case is 307 divided by 242, okay, 1 over 4 minus 1 equals to R. So those who use financial calculator, easy. You just compute IY. But if you're using the manual way, the scientific calculator, these are the moves that you might want to use. And it's a bit longer, way longer. Okay, 307 divided by 240, power of 1 over 4 minus 1. What is your R? Okay, so the R that you get here, you will be most likely getting 0.00613. Sorry, 0.0613 or 6.13%. Okay, so this is the place. When you're talking about decimal point, you use 4 decimal point. Okay, if you convert into percentage is 2 decimal point. All right. If it's a value on money on prices, it's 2 decimal point. But if it's a whole number, then it's 4 decimal point for accuracy purposes. Okay, so remember this. All right. So B, just now, the question A is 2424 years and future value 307. So B is R unknown. Okay, R unknown equals to 896 divided by 410, 1 over 8 for 8 years minus 1. C is R equals to 162,181 divided by 51,700 for 16 years minus 1. No tutorial video about using financial calculator. Financial calculator, just key in like what I tell you just now. Financial calculator, you just need to key in like what I tell you just now. Okay, so in this case here, 483,500 is the future value. All right, 18750 is the present value. The T is 20, the N is 27, and then compute R. So if you using the BA2 plus calculator, let's take this example, B, yeah? All right, 896 equals, press N96, then press your FE. Plus minus 410, click PV. All right, 8 N, compute IY. Simple. Okay. Yeah, just key it. Solution uploaded by your lecturer or by your module leader, they will ask you to click in plus minus in FV. But usually, yeah, because present value is reverse, is back, so it's negative value back then. Okay, so you can put plus minus in PV. So either way, you want to put in PV or FV, as long as one of the V must be negative, then you'll get your answer. Okay, so in this case, you'll get 10.27 straight away. Okay, here you might get 0.1027. All right, this one get 0.0741. If you use financial calculator, straight away give you 7.41. And last one, this one you compute, you get 0.1279, or if you use calculator, 12.79%. Okay, so very simple. To solve your calculation with financial calculator, especially those of you who are using BA2 plus, just make sure your PV, remember this only lah, no need to put PV or every time. Remember, anytime you do PV, you put a negative sign there on the number. All right, then always key in the number before clicking the variables after that. And then lastly, only you compute whatever is missing. Okay, this is for BA2 plus. For those who are using other brands on HP, Dell, Sharp, or whatsoever, you need to go and understand your calculator. Find out, read the manual. Okay, I'm no expert on calculator. I only know how to teach you according to BA2 plus. Or worst case scenario, if you happen to use the same calculator as mine is using the Sharp. Okay, then you can ask me. Other calculator, okay, you just need to try and error, practice yourself, make sure you know your calculator well. Because in the exam, your calculator is your best friend. If you don't know how to use your calculator, that's it. Or if you too trust a calculator and sometimes the calculator gives you the wrong answer, that's it, you're gone. Okay? So we already count FV, we count PV, we count interest rate. Of course, the last one, they want you to practice counting the years, your N. Okay, N. So number 5. Okay, number 5. And the formula is a bit complicated. Okay, N means T, yeah? T is equal to ln FV over PV divided by ln 1 plus R. Okay, this is to count your N. With calculator, very easy. No calculator, this is when you count. So for question number 1, 5A, sorry, count T. They give you your present value and future value and interest rate. So ln future value here is 1284. Present value 625. Count the bracket first, then ln it. Then ln 1 plus 9 is 0.09. Okay. Yeah. This is how you count. So key in the figure and get, if you use a financial calculator, again, click 1284 FV plus minus 625 PV, 9 interest rate, compute, and be your answer. Okay, this one 8.35 years. We get here 8.35 years. Repeat the calculation for the rest of the 3 questions. Okay. T equals to ln 4341 divided by 810 divided by ln 1 plus 0.11. C, T equals to ln 402 662 divided by 18,400 ln 1 plus 0.17. And lastly, ln 173 439 21,500 ln 1 plus 0.08. What is the answer? Okay. So if you use a financial calculator, you just compute n. You get very simple, 16.09 years, 19.65 years, and 27.13 years. Can. So try, those with financial calculator, please practice with the financial calculator. Don't wait until the end of the semester or during the exam when you try to explore it. You're going to be too late by then. Try now. Try to explore it now. Okay. So far, any issues? All can get? Can you all get the answers? Are you all right? Good. I see a lot of familiar names. Okay. All right. Good. So now, if no one's stopping me, I will assume you are all right. I will move on. So if you have issues, please stop me. Don't be shy. Don't be influenced by your classmates. Don't feel intimidated by them too. So voice out if you think you can't follow me or you need further explanation. I will slow down or I will stop by to let you know what is the solution or better explanation on it. So number 6 here. An investor purchasing a British console is entitled to receive annual payment from the British government forever. Forever, huh? So this is a perpetuity already. So when you see the forever, very simple. When you see discounted valuation, you see forever, never ending, then you know this is a perpetuity question. What is the price of a console that pay 150 annually if the next payment occurs 1 year from today? The market interest rate is 4.6%. So this story is telling you what? This is a story. This is a timeline. Okay? They're telling you time 0 and there's no time because it's forever, infinity. So what happened here when it's infinity? They tell you you receive payment constantly, infinity. Okay, they will pay. You receive annual payment from the British government forever. All right. What is the price of a console that pay 150 annually if the next payment occur 1 year from today? So that means every year you get 150 until forever. Okay. The interest rate given to you. Interest rate given to you is 4.6%, or could be written as 0.046. Okay, 150 forever. They want you to count the present value. How much will you pay for this? So this question I told you is a perpetuity. So when it's a perpetuity, the formula is very simple. PV is equal to C over R. Or another way to write it is PV is equal to PMT, stand for payment divided by I. It's the same, just a different way to write it. Okay, so in this case, you want to find the present value. C is the coupon rate or payment, we call it. It's 150 per year. Interest rate is 4.6, so 0.046. So what is the price that you should pay today to receive this benefit forever? So 150 divided by 0.046, you get 3260.86. That means today you pay 3260.87 to the British government to buy the British console, and then you will enjoy 150 annual payment per year forever. Most likely when you say forever, yeah, until you die lah. So this is very easy. So this kind of question, you use PV equals to C divided by R of PV, payment divided by I. Can you see this? Perpetuity, and they say forever, never ending, okay, eternally, and any other words that has the same meaning as this. Then you know you use this one. Very easy. Okay? So after done with this, let's look at question number 7 instead. So is it so easy, Now, Connolly has identified an investment project with the following cash flow. If the discount rate is 10%, what is the present value of this cash flow? What is the present value at 18%? So they want you count two differently. One at 10%, one at 18%. How do you want to do that? Very easy. Very, very, very easy. Okay, so basically you want to discount. This is multiple cash flow. That means each cash flow represent a different value. Let me draw a straight line. Okay, year 1, 2, 3, 4. 1, 2, 3, 4. Different cash flow. 960, 840, 935, 1350. 0, 1, 2, 3, 4. So they want you to count with two different interest rates. One is when it's at 10%. Another one is when it's at 18%. So you basically need to count the present value here. Okay. So just now, if you do the present value, you know PV is equals to FV divided by 1 plus R power of T. So in this scenario, you have 4 different cash flow in every year. So you need to count 960 when it's discounted backwards to times 0, how much it's going to be. 840 discounted 2 times. 935 discounted 3 times. 1350 discounted 4 times. Okay, so let's count together. So take the 10% one, PVA at 10%. All right, so you take future value, year 1, 960. 960. 1 plus 0.1 power of 1. Okay, plus 840. 1 plus 0.1 power of 2 plus 935. 1 plus 0.1 power of 3, and lastly plus 1350. 1 plus 0.1 power of 4. Total up all this together, you get your present value at 10%. Repeat the same thing for present value at 18%. 960. 1 plus 0.18 power of 1. 840. 1 plus 0.18 power of 2. 935. 1 plus 0.18 power of 3. And lastly, 1350. 1 plus 0.18 power of 4. So count the difference for both of these. Okay. By the way, for those of you who are not sure on how to use the calculator, the solution that your lecturer will upload or your module leader will upload on the times will consist of the step-by-step way on using the calculator. So if the class explanation on using the calculator is not clear, you may always refer back to the tutorial solution. Okay, you may always refer back to the tutorial solution. Sometimes I might calculate wrongly also, all right, because I don't really refer. okay, other than the final answer. All right. So, like for example here, now for the final answer here, I'll refer because I don't count one by one. So you should be getting here 3191.49. And here is 2682.22. Okay, this is basically counting multiple cash flow present value. Multiple cash flow, different kind of cash flow. You want to calculate it back into today's present value. Ken, are you okay? Anyone lost so far? Are you lost? Anybody lost? Any students are lost? You don't know what's going on? You're blank totally? Nope. Yes, no? No, yes? Okay. Thank you, Trisha, for responding. Okay. So let's move on then. We already count single present value, simple interest rate, compounded interest rate. Now, multiple cash flow discounted rate. And let's see what's the next on 8. Number 8. All right. Number 8, an investment offer 4,900 per year for 15 years, with the first payment occurring 1 year from now. If the required return is 8%, what is the value of the investment? What would be the value if the payment occurred for 40 years? And what happened if it's for forever? Okay, so you account first one for 15 years, and second one for 40 years, and last one is for eternity. Okay, so this question basically is telling you something like this. Giving you a timeline like this for 15 years. Okay, we do the 15 years one first. 0 and 15 years. Okay, the interest rate is 8%. One, two. You are getting a payment of 4,900 per year for 15 years. All right. So what is the value of the investment? Okay, you need to count the value of the investment. Just now, we just count present value when there's only one present and futures. Again, you just count present value with futures. All right, the standard one, the standard equation, PV equals to FV divided by 1 plus R power of T. This is the normal present value. But now, because you're annually getting money, so this one is called present value annuity. PVA equals to C, all right, 1 minus 1 over 1 plus R power of T divided by R. Okay, 1 minus 1 over 1 plus R power of T divided by R. So this question number 8, we are using PVA. Means present value annuity. Every year there's money coming in. So to count this, you want to count here PV. Okay? PVA is equals to C is 4,900, the amount of money they pay you annually. 1 minus 1 plus R, 0.08. Power of T is 15 years. Divided by R is 0.08. Okay? Count your answer. how you answer. This is for scientific calculator. Please know that. So, oops. If you're using a financial calculator, again, you don't know what is your present value. You need to compute. All right. So what do you key in is 4,900 as PMT. Okay. 0 for future value. 0 for future value. What else I'm missing? Interest rates, 8%. Okay. And 15 for N. So you compute PV. The answer that you should be getting is 41,941.45. Okay, this is for 15 years. So the question tell you what happened if it changed to 40 years. What happened if it changed to 40 years? If it changed to 40 years, you just basically change the time. Okay, so the PVA is still the same, 4,900. 1 minus 1.08 power of 40 divided by 0.08. Change the n into 40 years old. Okay, for 40 years. So this one will give you $58,430.61. $58,430.61. And of course, the last one, when they tell you is forever, the formula I tell you is the same one. Is PV equals to C over R. Okay, so C is payment in a yearly basis, 4,900. The R is 0.08. So if it's a perpetuity, this is the answer. 4,900 divided by 0.08. You get 61,250. Cannot. Very easy, right? No rocket science at all. Okay. So just follow the timeline basically. Just put it in a timeline like this. As you can see very clearly. Alright. Count back the present value. And these are the answers. 41,941.45, 58,430.61. And when it's perpetuity, because they tell you what happened if it's forever, 61,250. Easy. Okay, this is the easiest formula. Okay, looking at question number 9, let's see what question number 9 tell you. The Perpetual Life Insurance Corporation is trying to sell an investment policy that will pay you and your heir 15,000 per year forever. You see, when you see this forever, you know it's confirmed PV equals to C divided by R. If the required return on this investment is 5.2%, how much will you pay for the policy? Suppose the Perpetual Life Insurance told you the policy costs 320,000. At what interest rate would you think would this be a fair deal? So the first part of the question, they're just telling you like this. Okay, this is a insurance plan. They pay you and your heir. That means your next generation also will get 15,000 per year. You die already, your second generation also can get. Okay, so Investment is 5.2%. First, they want you to count how much we will pay here for the policy. So PV, so just use a PV lah. PV equals to COR. 15,000 divided by 0.052. Okay, digit. That means to pay for this benefit, you pay 288,451.54 now to get this benefit. A lot of money. Okay. The second condition, suppose the voucher line is told you the policy costs 320,000. What interest rate would this be fair? So now they're giving you the opposite. They give you the value $320,000. So they tell you it's actually $320,000. This one, don't know. Okay, this one don't know. So this question will tell you PV is equal to $320,000. C is still $15,000. R is missing. Okay, R is missing. So R is basically equals to 15,000 divided by 320,000. So this will give you what figure? What a figure you get for here? 15,000 divided by 320,000. Anybody? Simple calculation. 15,000 divided by, yes, very good, Chao Chen. 0.0469 or 4.69%. Piece of cake. Very easy. Okay? Very easy. Can, huh? Very easy, right? Okay. All right. Question number 10. Very trick question here. This one is a bit confusing and tricky. So let's convert the table into a timeline. Okay, they tell you the present value of the following cash flow stream is 7,300 when discounted at 8% annually. What is the value of the missing cash flow? What is the value of the missing cash flow? So put it into a timeline. Okay, 1, 2, 3, 4, 4 years. Year 1, 1,005. Year 2, unknown. Year 3, 2007. Year 4, 2,900. At year 0, PV is equal to 7,300. Okay, 0, 1, 2, 3, 4. Okay, interest rate is 8%. They want you to find what is this cash flow here. So basically, you need to count the discounted value of this whole thing. This discounted value of the whole thing. Okay, so PV at 8% is equal to 7,300. So 7,300 is equal to 1,500 divided by 1.08 power of 1 plus question mark divided by 1.08 power of 2 okay, plus 2,700 divided by 1.08 power of 3 and plus 2,900 divided by 1.08 power of 4. So count it one by one first. What do you get? So 7,300 is equals to 1388.89 plus unknown, okay, plus 2143.25 and plus 2121.89. So we're going to find x. So x is equal to 7,300 minus all these balances. Okay, so x is equals to, x divided by 1.08 power of 2 is equal to this amount. 1636.18. Okay, 1636.18. So this one shift on top, your x is equal to 1636.18 times with 1.08 power of 2. Okay, so what is your value here? All right, what is your value here? The value here should be 1908.44. Can? Oh, can. Can follow, cannot follow. Very good. Financial question in question 10. Financial question in question 10 actually very easy. So if you follow your solution given to you, you click in the cash flow one by one. But if you ask me, I think it will be better to do it manually because you won't do any mistake. But if you're going to use financial calculator, you insist on using it to make sure you key in your cash flow. Okay, started with 0. Cash at 1,005. All right. Don't care about your F. Okay. Then cash at 02, you click 0. Cash at 03, you click 2,700. Cash at 04, 2,900. IY 8. And then NPV compute. You should get 5663.82. So 5663.82 is the total of all these other than this one. You don't know your cash flow too. So you still need to take the 7,300 minus of 5663.82 to find your 1636.18. And this 1636.18 is considered as PV. Okay. Then you key in your interest rate again, IY. Then your N is 2, second year. Then you need to compute your FV. So after you compute your FV, you get the answer. To me, I think using the calculator for this question is much more complicated. So it's up to you. You want to follow. If you want to follow, this is the way you follow the calculator. Use the same method you use to calculate your NPV. Okay. Any more questions so far?